Hey everybody, welcome back. We're going to be really specific in this video, so you're probably going to want to watch a couple parts of this a couple times. We're definitely going to go over the ES. I just want to go through the basics so that we're all on the same page with what happened today. Number one, 1 p.m. today, there was a 20-year bond auction, and the bond market actually did what? Went up today. So the idea that this was a bad bond auction and that's why we sold off is not an accurate statement. You can see very clearly here TLT and how bond prices actually finished up over the open, which clearly shows bonds were being bought. We take a look at the 10-year, and we will get to the indexes, but I want to get to what the issue was, which is really the VIX, which was really a non-event in my opinion, but it is what it is. So you can see 387.78, 387, right? We take a look at here, they bought the 10-year. To the end of the day, they bought the 10-year, which is setting up a gravestone at the bottom, which is telling you what? That rates are going to go lower. This is what you deal with, and this kind of volatility is what you deal with on this week. This week has very light volume, and they play a lot of games, and there's really nobody to catch them because nobody is going to be pot committed going into the end of the year. Meaning you're just not going to have institutions that are going to go out there and say, you know what, I really want to take advantage of this. What they're saying is, you know what, I'm going to call it a day and I'll come back in 6-7 trading days and get involved again and start building positions. All you've done so far is not even come down to the 47.34 level. It is very realistic to have some kind of pullback from this move. We've been talking about this for some time. In the community, we've been talking about how we are grossly overbought. As a matter of fact, I've been talking about it every single day in the pre-market newsletter. There's a statement at the bottom that clearly states we are grossly overbought. And the reason that I've been saying that is we are grossly overbought. Here's the 50% line. Okay, if you were to look at this retracement back from November 1st, that puts you at 4,500. Now, are we going to 4,500? Let's be really obvious here. Nobody knows. No one really has a clue. But if you think that you can't come back and retest just the 12, and that is really nothing, that is a nothing move. You've been here before, and just test it. That's not a big deal, guys. And so we have to look at this and say, okay, what's the issue? You hit a high and then you reversed. It's that kind of week. If you've been trading for any period of time, you know what kind of week this is. And this is one of the reasons why I've been saying that if you're trading this week, you need to really just have really tight stops and keep moving your stops up. And I'll show you a couple examples of this. But for example, if you think about the 12 and how you're holding that, to come down to here would be another, 50 points? It's not really that big of a deal, right? So, and to think that you're just going to have a one-day event like this, it's not realistic, right? You're going into GDP tomorrow. We're going to go through a bunch of data here, but to think that you're just going to have one day of this and you can't come back down and retest this 16.5, it's not realistic at all. 5% drops and corrections, they're really nothing. That's a 3% drop, 4% drop to the 22. It's absolutely nothing for the market to do something like that. 5% drop takes you right into the middle of all of this, which is 16.2. It's nothing for you to do this, guys. You know, I don't feel like I should be saying this anymore, but you don't have a Fed backstop. You have actual volatility and you have people that are on margin and they're paying interest on margin. And this is one point that people really need to start wrapping their head around. If you have a Fed funds rate, let's clean all this off. If you have a Fed funds rate and that Fed funds rate is 5, right? You're at 5.33. You are not in a position like you were for the past decade, starting back here during the great financial crisis, all the way to here. And then we had this little blip. Frankly, it didn't really start till about here. We had this blip where people actually had margin interest. And then if you were only trading for the past 3 years, you haven't been paying any margin interest. All of a sudden, it costs money to be on margin. That increases the level of volatility of the stock market significantly, because not only are you losing money on margin, you're paying to lose money on margin. Institutional traders know this and they reduce margin fast. This increases the volatility of movement throughout the market. So if you are used to trading only from this period in time, from 08 to 22, you've only had to deal with this very slightly up here. And this was nothing. This was nothing compared to where you were at. And this is what we had to deal with back in the day. Now I feel like my father, but back in the day, this is what you were dealing with all the time. So you had to make decisions. Did you want to be on margin at 8%? Did you really want to own Cisco here going out that long? You didn't have to make those decisions here. You had literally free money. So now when people are going out there and they're buying the NASDAQ, let's go out there on the daily, they have decisions they have to make. And you're going into the end of the year on light volume, on a huge volatility, and it's going to get worse and worse on the volatility side as the week plays on. And I really want people to understand that. And that's why I'm hammering this home. So I saw today a lot of people, especially in the community, talking about they were just surprised. It's very difficult to be surprised when you have so many indicators that are glaring that you're grossly overbought. You're just waiting for something to happen. And people saying, oh, it's the VIX and the VIX expiration, and then this is going to go back. Do you think all the people that got out of that VIX are now going to put that trade back on? Of course they're going to put that trade back on with the way that this just spiked. So what does that mean if they didn't put the trade back on today after the VIX expired? That means they're going to come in tomorrow and do it. All right. So then the idea that this is going to just be a miraculous one-day event and then we're just going to go back up, it's not realistic. It's not how this works. So they can reduce. You hit all-time highs to come back and test a level. It's just healthy. Now let's just do the most simplest of indicators and look at the 3, the 5, and the 8 on a 15-minute chart and overlay them here. And I know that this is not consecutive, but I keep them consecutive, and I'll show you why. I'm going to take off the pre and the post here. By me keeping these consecutive the way that I do on the futures market, I just break them up into sections of 6.5 hours, just like the NASDAQ trades. When I look at the futures market, I get a reading, an indicator ahead of time. You might want to listen to that again, but this gives me an indicator of what I can expect out of the Qs if I just watch what the NQ does and I overlay the same set of indicators on it. You might want to listen to that again because I don't know that I did the best job explaining it. But what I'm trying to say is the futures market overlaying the same indicator I use here on the Qs, it triggers first on the NASDAQ. Therefore, I want to watch that. You have the 3 and the 5 that you just broke. You have not broken the 5 on the Qs since when? Since you popped over it here, December 7th. So this is your first indicator that things are getting a little tired. That should not be the biggest shock in the world that things are getting a little tired up here. Right? You've had monster moves here, and to have some kind of pullback is not unrealistic. So my suggestion with the data that's coming out tomorrow, just be aware that this is very possible. Let's look at the ES. And you can see very clearly, what did you do? You broke the 3, the 5, and the 8 today. Put in this SPY, and you can see what I'm talking about. You broke the 3 and the 5, and here you are. When did this flip? Back in here, all right, 7th. So it's been weeks, 3 weeks of doing this. And one of the indicators that we went over ad nauseum, besides smart money, dumb money a couple of days ago, we went through the S&P watch list and we went through how these levels, let's pull these up, were all the way up here and we were due for some kind of pullback. Now, this is a monster move. We're going to review all of these and you're going to want to pay attention to this. But on the 5-day, you're down at 17. Most reversals, most short-term reversals happen at 7. Okay? They happen in this 7 range. If you go and mark this off, we're not going to have the time to do this. But if you go and mark this off at 7, you will see levels in here. Okay, just literally S5FD. You can do this on TradingView yourself and go from there, S5FD. And you can go and see these levels very, very clearly. This video is going to be unedited, very raw, because I have conferences right after this that I have to attend. So I'm trying to get this out so that you actually have data to make more informed decisions tomorrow. Comment below if it's too raw, but I really just want to get this out. We talked about this as well on Saturday. The Saturday videos, guys, are for you guys to utilize this information and then help you make better decisions today. And that's really what I want you to understand. So when you start seeing these levels and you go back, and every time we got to here, we've seen some kind of pullback. Here we are again. So this is something that we'd want to pay attention to that's right up here. And this is the 20. Let's just keep rocking and rolling through them. Here you are in stocks at the 200-day moving average. We literally were just talking about these on Saturday. Okay? And you go and take a look at here you are January 31st, and you can see what happened in the S&P. What happened in July? Same level, same soup reheated, right? So when you get to these levels on a technical basis, you're due. Just like when you get to the S&P stocks above the 50-day, when you get here, you're due. And I want to be really clear about this one. S5FI. When you get up here and you get to this level, you never know when the music's going to stop. So you don't stop moving. What you're doing with your trades is you're moving your stops up tighter and tighter. And this is what they're seeing in the room. I'm constantly moving my stops up and I'm constantly getting stopped out of newer trades or pulling the trades off early. And then you have to make some decisions. Before I get to this here, I'll show you what I'm talking about. So we're going to focus on this. This is just me explaining a pattern in the middle of the day about VNO and what I see going on there. And I still like the REITs very much. But Microsoft's hitting a new high of the day, and that's at 1221. At 1250, if you look right here, let me get my fancy pointer. If you see this right here at 1250, Microsoft if Microsoft was a day trade from yesterday's alert, I put an alert out on Microsoft at 373. You've hit a possible short-term top signal developing. Do what you want with that. So there was a concept I introduced yesterday to everybody in the public video. And what I said I showed the SMCI trade is, you have to decide who you are as a trader before you put the trade on. Meaning you have to make a decision on who you are. Are you someone that's willing to hold this to break even? Are you someone that's willing to hold it to my initial stop, which is 370? You constantly have to be assessing your risk. I'm going to say this again to everybody. You have to constantly be assessing your risk on every single trade. Whether, I don't care if you're going to say, oh, I'm an investor, I don't need to do that. It's nonsense. You need to do that. If you don't want to do that, I would just go buy an index fund and call it a day. But otherwise, you're going to have a problem. So you have to assess this. And you have to say, okay, am I willing to use that low of the day? Am I willing to retest this level? Where am I willing to get stopped out at? Am I willing to get stopped out at break even? You have to quantify your risk at all times. So the point of me putting this out there when it was there is, this is a reversal pattern. I don't need anything else. This has a 55% chance of being a reversal pattern, all right? And it's a very simple bearish engulfing at the top of the chart after the secondary move, right? Here's your first move where you fail. This is your secondary move. If you get a secondary move and you get a reversal pattern, the chances of that reversal pattern when it's a bearish engulfing are up 55%. You can just remember that. So when something like that pops up, I just put it out there. Because if you're day trading, and that was not a day trade, that was a swing trade, but I'm putting it out there. And what I'm saying is, hey, if you were going to do this and you wanted to get out, there's your opportunity. If that makes sense, comment below. You need to know who you are before you get in these trades, because you don't want to say, oh, it's a day trade, but you know what? I'm down in it. So now it's a swing trade. I mean, do you know how many of those I had when I first started trading 20 years ago? Oh, I'll just hold it. It'll come back. You know, if I did that with Cisco, it's 23 years later. Spoiler alert, it never came back. So that's why I go through these so much with you guys. And it's why sometimes I sound probably annoyed or passionate about it, because the reason I do these videos is so that you guys don't have to go through the same garbage that I went through, 2 decades ago. And I mean, lessons are there for a reason, right? Anyway, so you can see where you're at here and how this is playing out. Go and mark these dates. July 25th, December 22nd, all right, 2022. All right, just go and look at them. Wednesday, August 17th. Okay. And if you just go and look at them, I mean, we can overlay it here, but it's not going to overlay as well as I would like it to. Let's just go pop the SPY in really quickly. And what you'll note, if you just, here, let me show you what I mean by this. If you just look at these levels, you'll note that that's putting a high in. That put a high in, right? You can see these highs on the market just by doing it this way. That marked a high. You're possibly setting up for something like that here. And I think that that's something that you just need to be aware of. It doesn't mean that the market's never going higher and now we're going to absolutely correct and it's the end and now we're going to go into a recession and you knew it. Okay, you need to stop with your volatility switch, all of us, where we're just doom and gloom or everything's rosy. There is a middle ground. And all I want people to understand is when I'm showing this, every time since it's been up here, like literally every time it goes up here, okay, you hit a point where it goes into this level, where it gets back down to that 3 or 4. Usually the lowest was 18. It doesn't happen right away. So this could mean that if you start to roll here, that you have put in a top that might last for a month or two. And that's not a bad thing. It's not a bad thing if you put a top in on the market and we rotate through sectors and this just kind of churns around and we just go through the sectors. That's not the worst thing in the world, guys. And I just understand that. It's not a bad thing. You can't expect XBI to go up the way that it did, all right, and be up 30% in a month, it's normal. It's not a big deal. Every biotech index always goes up 30% in a month. It's not normal to expect that and then be freaking out over a 4% correction. So you need to look at that and just assess it. Same thing here with the regional banks. Of course, they're going to have pullbacks. And this has nothing to do with anything fundamentally changing with the regional banks. Bonds actually got stronger today. The bond market actually got stronger today. Okay, no matter how you look at it, we still hit a high on the bond market there on high yield. If you go and take a look here at LQD, okay, you still hit another, well, not another closing high, but you still finish green. You look at TLT, you hit another high from the November talk when Powell had his first speech where he said he was going to stop. So you start going through these and you start looking at them, and all you're seeing is buying of bonds. And that's not going to stop regionals from dropping because people are going to get scared. They're going to have weak hands, right? They don't want to go through pain. And that's part of the game. So this is more of a I'm trying to get people to understand this. And it's one of the reasons why I think I should do more like at night, one night a week live calls so people get this stuff. What'd you do with XLRE? All you did was come back and test your support level. Maybe you crack, maybe you don't. Does that mean that they're not going to raise rates or that REITs aren't going to go higher? No, it means you had a down day. That's all it means. And so you kind of have to put this stuff in check and really take a look at what's actually happening. I really hope that this is helpful, and I really hope that people get this and what I'm saying. Did the dollar explode today? No, it kind of went sideways. So we really don't have anything that we have to worry about there. Okay, so bonds rallied, the dollar went sideways, and we're all freaking out because the VIX went up 9% after getting cut in half. All right, so when you just put it in context, and I really think that that's how you have to look at it. I'm not saying it wasn't painful if you were on the wrong side of it, right? That's not what I'm saying. But earnings are not bad. Look at Micron this evening and what they did and how they came out with earnings after selling down and scaring everybody and then coming out and saying, by the way, that loss that we were talking about having, yeah, we're going to cut that loss in half. And revenues are better than we thought. That's what happened tonight. That's what's happening. I understand that you're going to get these sell downs. I understand that you could trade sideways, but that's what happened with Micron tonight. That's why it's up $4 right now. All right. That's what's actually going on out there. You can't expect names like Mara to just go from 10 to 22 and then, oh, you mean we're going to have a down day? Well, the market must crash, or it's just going to consolidate, build, and go higher, right? I mean, one of those two things is more likely than the other. And people will say, well, maybe it's FedEx. Well, then why didn't the market crack when FedEx cracked this morning? Why would it wait till the end of the day? Bottom line with what you're dealing with today is you're dealing with weak hands because you don't have any support out there. That's what you're dealing with. So when you got to these levels, you were able to see selling. Selling begets selling, and you have weak hands. Everybody remember how much money is out there in retail right now. Now, this is smart money, dumb money. And we refer to this as institutions and retail. And I just want to, just so everybody gets this, this is how much retail is in the market right now. You're at unprecedented levels. It's why I went over it. You haven't seen these levels since when? We had 1.7 trillion injected in the market. Try not to laugh when I say it. Look at how rare it is to be up here. And look at how that usually goes. It doesn't go very well. When you're up here and it starts to turn, it marks a high. There's another indicator that's marking a high. And you're seeing institutions come up behind it. But when you really look at these levels, you had some huge anomalies before the pandemic and after the pandemic, but you've never had anything like this for 10 years. Even when you go back 20 years, it's very rare. You had the great financial crisis where you peaked and then came back down, but it's very rare to be up here. And when you zoom in on it and you see how high you are, it's pretty staggering. And so this is going to drive the market. Retail is driving the market. Retail panic is going to drive the market. Now, we didn't crack, which is what you're really looking for to denote that high. And we'll have to see how this data sets up. Reminder, this is only right here, which is the 20th, but I think you're actually going to not have the 20th data in yet. So we're going to have to wait for that data to come. But this is something that we need to pay attention to. So I would expect the volatility to increase. I would expect at least, I'm going to be really short term here. I would expect at least another day of this, at least off the open, unless GDP absolutely comes in lower. Now, these are things that you should be watching tomorrow and then prepping for what's going to happen on Friday with PCE. But you have GDP growth rate, price index, quarter over quarter GDP coming out at 830. 2.1% was previous. Here's the consensus. That is a huge disparity. And maybe this is what scared people at the end of the day. Maybe it leaked. Wouldn't be the first time that a Fed number actually leaked. Could be the VIX triggering, which took risk off. But how many retail traders are actually putting on the VIX trade? Okay, so that's why I showed you smart money, dumb money. I don't believe it's institutions panicking. I believe it's retail that's panicking. I believe it's retail that's going to cause the sell-off, quite frankly. So look at that consensus, though. Did it leak? Maybe that's the problem. But this consensus is way higher than the previous. That's definitely something we have to pay attention to. Jobless claims is not going to be a big deal. Philadelphia Fed, the previous number versus consensus, people are going to watch, but that's not really the issue. PCE will be on Friday, but PCE Thursday gives you kind of an indication on where that's at. People say it doesn't really. I would argue a little bit that this does give you a little bit of an indication. And then you have a bunch of other data that's going to come out with new orders, new employment, Philadelphia Fed prices pay, business conditions. People will look at this tomorrow, okay? They're going to want to see how bad the economy actually is. But the big number you're going to want to watch is this consensus of 5.2. Now, if you come in lower and you're looking for 5.2, then that's great. If you come in higher, the market's going to sell down. Period. It will, because they're going to push out the rate cuts. That's how the market will view it. No matter what he's going to do, it doesn't matter. That's how the market will view it. They will push out the rate cuts if that comes in what? Higher. So your number to watch tomorrow is 5.2. After you watch that number, please listen to this part very, very closely. After you watch that number, you're going to want to watch these T-bill auctions. Okay? You're going to want to watch and see how aggressive they are buying the T-bill after you have GDP and you have the TIPS auction 5-year at 1. The mortgage rates you're going to want to watch, but you really want to watch the T-bill auctions and the 5-year and see how that plays out and go from there.